Two men, same age, same job, same paycheck, same $50,000 sitting in the bank. One of them is about to become a landlord. The other is about to become invisible. And 20 years from now, one of these decisions is going to look like genius, and the other is going to look like a mistake nobody warned him about. Here's the strange part. You'd never guess which one wins by watching the first 3 years. You'd bet the house on the wrong guy. Literally, Ethan and Lucas grew up 2 streets apart, went to different colleges, and ended up, by pure coincidence, earning the exact same salary, $65,000 a year, both 28 years old, both renting apartments, both driving cars that had seen better decades. Neither of them took vacations they couldn't afford. Neither of them upgraded their phone every year. They just quietly stacked cash month after month until each of them had exactly $50,000 sitting untouched. That number meant something to both of them. It was the first time in their lives either man had real deployable money, a decision point instead of just a paycheck. And that's exactly where they split. Ethan had always been the guy who wanted to own something. Property felt real to him, something with a roof and a driveway, something you could stand in front of and say, "That's mine." Lucas thought about it differently. He wasn't chasing anything he could show off. He wanted money that worked without him, quietly, in the background, while he lived his life. So this isn't a story about which stock to pick or which neighborhood to buy in. This is a 20-year experiment in 2 philosophies, and the ending is nothing like what either of them expected when they started. Ethan moved first. He found a $250,000 rental house, nothing flashy, just solid, in a neighborhood with decent schools and steady demand. He put his $50,000 down, financed the rest with a 30-year mortgage at 7%, and locked in a monthly payment of about $1,330. 3 weeks later, he had a tenant paying $1,800 a month. Do that math for a second. $1,800 coming in, $1,330 going out. Call it $470 a month just showing up. Ethan didn't just feel like he'd made a smart move. He felt like he'd found a cheat code. Lucas, meanwhile, did something almost embarrassingly undramatic. He moved his $50,000 into a total stock market index fund. No property, no tenants, no toolbox in the trunk of his car. After bills and a healthy emergency cushion, he had about $200 left over each month, so he set up an automatic transfer, same day, every month, and then he closed the app and basically forgot about it. If you'd asked either of their friends who was winning at that point, there's no contest. Ethan had a house. Ethan had a tenant paying him rent. Ethan had something he could drive by. Lucas had a confirmation email. One investment felt real. The other felt like nothing at all. But here's the thing about feelings. They're a terrible way to measure whether money is actually growing. The first few years were kind to Ethan, at least on the surface. Rent landed in his account like clockwork. Every payment chipped a little more off the loan. He'd drive past the house some evenings just to look at it. I own that. The value crept up, the equity crept up, everything reinforced the story he was telling himself. Lucas's experience looked nothing like that. Every few months he'd check his balance. Sometimes it was up, sometimes it dipped. Most months, honestly, nothing seemed to be happening at all. No tenant thanking him, no building he can point to, just a number quietly shifting on a screen, refusing to be exciting. Ethan's friends asked about the rental constantly. Lucas's friends barely asked about his portfolio at all. From the outside, Ethan looked like the successful investor. Lucas just looked patient. 3 years in, the two of them are on paper looking pretty different. Ethan's collected roughly $64,800 in rent, paid out about $47,880 in mortgage, and on paper that's close to $17,000 sitting in his pocket, except it isn't, because owning a rental house means the bills don't stop at the mortgage. Property taxes, insurance. A tenant who moves out and leaves the place empty for a month while you scramble to find someone new. Maintenance that never announces itself in advance. None of these expenses look catastrophic individually. Together, they quietly erode almost everything that looked like profit on day one. And then there's Ethan's time, the part nobody puts in the spreadsheet. He's managing the property himself, which means late night calls about a broken water heater, weekend trips to meet a contractor, repair scheduling squeezed into his lunch break. By the time year 3 closes out, that $17,000 profit has shrunk down to a few $1,000s. And that's before anyone puts a price tag on the hours he spent being a landlord. Lucas's number, by contrast, is almost boringly simple. His original $50,000 plus 3 years of $200 monthly contributions, growing at something close to the market's long-term average of 10% a year, has become roughly $76,000. He hasn't fixed a faucet, he hasn't fielded a single 11 p.m. phone call. The money just kept doing its job. But don't count Ethan out yet, because he's holding something Lucas doesn't have access to. Leverage. His $250,000 house is now worth somewhere between $275,000 and $280,000, depending on how the local market's behaved, and every mortgage payment he's made has chipped away at what he owes. Added up, and his equity sits around $80,000 to $85,000. That's real wealth. And a huge chunk of it came from controlling a $250,000 asset using only $50,000 of his own cash. That's the one trick the stock market simply can't replicate. It's also exactly why real estate has built so many fortunes over the decades. But here's the part almost nobody talks about in the comments section. A rent check feels like profit. It isn't. It's just where the real math starts. First, there's vacancy. No rental stays full forever, and the standard rule of thumb is to expect about a month of empty unit every year. That's a month of mortgage due with zero rent coming in. Then every time a tenant leaves, you're paying for cleaning, fresh paint, small repairs, advertising, and screening the next person. Then there's ongoing maintenance. A rental is a physical object, and physical objects break. Budget 1 to 2% of the property's value every year just for upkeep. On a $250,000 house, that's $2,500 to $5,000 annually, some years less, some years brutally more. Then come the expenses that aren't surprises, exactly, they're inevitabilities. Roofs, water heaters, furnaces. You don't know when, only that. And when the bill lands, it can erase months of rental income in one afternoon. Hire a property manager to avoid all this hassle, and you're paying 8 to 10% of the rent for the privilege. Manage it yourself, and you're paying with something else entirely, your time. That's why anyone who's actually run the numbers on a rental knows that rent minus mortgage isn't a formula, it's a fantasy. The real number only shows up after every hidden cost gets counted. And that's exactly what happens to Ethan. 5 years in, he's not the wide-eyed first-time landlord anymore. He's been through 3 tenants. The roof had to be replaced. A plumbing emergency showed up out of nowhere the way they always seem to. The unit sat empty more than once between renters. Rent has climbed to around $1,950 a month, but so have property taxes, so has insurance, so has everything else. Run the full accounting, and Ethan's actual cash-on-cash return lands somewhere around 3 to 5%. Respectable. Nowhere near the 15 to 20% some guy on the internet promised him. Lucas's story, in the meantime, remains almost aggressively uneventful. He hasn't chased a hot stock. He hasn't tried to time a recession. Every month, another $200 goes in, same as always. By year 7, his account has grown to roughly $120,000. And something quietly important is starting to happen underneath the surface. His portfolio is now generating more growth in a single year than many of his own contributions add. This is the exact moment compounding starts to shift gears. The first few years feel like nothing. Then the gains start producing their own gains, and the curve starts bending upward on its own. Both men are building wealth. They're just doing it through completely different mechanics. Ethan's fortune depends on leverage, appreciation, rental income, and constant hands-on management. Lucas's depends almost entirely on time and doing absolutely nothing dramatic. One of these paths asks for your evenings. The other asks for your patience. By year 10, the comparison gets genuinely interesting. Ethan's house is now worth somewhere between $335,000 and $370,000. His mortgage balance has dropped to roughly $172,000. That puts his equity somewhere between $165,000 and $200,000, which sounds fantastic until you remember he's also sunk about $30,000 into taxes, insurance, repairs, and vacancy over that decade. Lucas's account, meanwhile, sits at somewhere between $170,000 and $180,000. He's personally put in about $74,000 of that over 10 years. Everything else, every extra dollar above that, came purely from the market doing what markets do. And here's the moment that surprises almost everyone watching this unfold. Their total wealth is nearly identical. Depending on how the property appreciated, Ethan might even be slightly ahead, purely because of leverage, but raw numbers never tell the whole story. Ethan reached this point carrying 6 figures of mortgage debt, with his entire net worth locked into a single house, in a single neighborhood, having personally sunk hundreds of hours into managing it. Lucas owns tiny slivers of thousands of companies spread across the entire economy, an investment he could liquidate in about 30 seconds that has asked nothing of him beyond one automatic transfer a month. 10 years in, nobody's won yet. They've just taken 2 very different roads toward almost the exact same destination. Now, fast forward another decade. This is the full 20-year picture. Ethan's property has kept climbing. It's worth somewhere around $500,000 now. His mortgage balance has fallen substantially, leaving him with roughly $385,000 in built-up equity. Over those 2 decades, the property has also generated real net cash flow after every single expense, about $120,000 all told. Some landlords will do better than this. Some will do considerably worse. Real estate outcomes swing hard depending on your market, your tenants, and how well you actually manage the asset. Lucas's 20 years look almost identical to his first 3. His original $50,000 plus 20 years of that same $200 monthly contribution, compounding at roughly 10% a year, has become approximately $518,000. Over that entire span, he personally contributed about $98,000. The other $420,000 and more came from nothing but growth. No debt, no tenants, no 2 a.m. phone calls about a busted pipe. So here's where it lands. Add up everything Ethan built, his equity, minus what he owes, counting every dollar of net cash flow he ever collected, and he finishes with roughly $55,000 in total wealth after 20 years. Lucas finishes with approximately $518,000. Same starting point. Same $50,000. Same 20 years. And the outcome isn't even close. Ethan built his wealth on leverage and accepted concentration risk, everything riding on one house, one market, one roof. Lucas built his on compounding and accepted market volatility, a portfolio that could dip 30% in a bad month, and there's nothing to do but wait it out. Ethan traded his time for his returns. Lucas traded almost nothing but patience. Now, before this turns into just buy index funds and never think about real estate again, that's not a fair conclusion either. Stocks carry real risk. They're just easier to look away from because there's no physical building reminding you every day. In 2008, the broad market fell almost 40%. In early 2020, it dropped more than 30% in a matter of weeks. Try watching years of savings evaporate on a screen and see how calm you feel. That kind of drop has ended plenty of long-term investing plans early, simply because someone panicked and sold at the bottom. Stocks also don't hand you meaningful monthly cash. Index funds do pay dividends, but the yield is thin. A $150,000 portfolio might throw off something like $250 a month. Nice. Not a paycheck. And leverage really is the one card real estate holds that stocks can't match. Lucas put $50,000 to work controlling $50,000 worth of assets. Ethan put the same $50,000 to work controlling a $250,000 property. When prices rise, that leverage doesn't just help. It multiplies the outcome in a way no index fund ever will. So which one actually won? Wrong question. Ethan believed real estate was the proven road to wealth. Lucas believed the market would quietly do the heavy lifting. They were both partially right. And the real deciding factor was never the investment. It was whether each of them understood everything that came bundled with it. The money, the time, the stress, the risk, what they gave up to get what they got. There's no perfect investment sitting out there waiting to be discovered. There's only the one that actually fits your life, your temperament, and what you're willing to trade for it. So next time somebody tells you real estate always beats the stock market, or that the stock market always beats real estate, don't argue. Just ask them one question: did you include everything? Because the only answer worth trusting is the one that counts every dollar, every hour, and every sleepless night that came with it. If this changed how you think about building wealth, subscribe, because next time we're running a different experiment. What happens when someone takes the boring path and the leverage path at the same time? That comparison might be the most surprising one yet.